Most of the videos on my channel are actually related to Forex, but I'm actually going to be switching over to stocks and options now as I actually make more money from trading stocks and options than I do from Forex. So this is going to be a basic guide on what is options trading. So let's go ahead and get started. An option is based off of either a stock or an ETF for the most part. There is other things it can be based off of, such as indices, but mainly they're based off of stocks or ETFs. One option contract is equivalent to 100 stocks. That's really, really important. If you end up in the money, which I'll explain what that means on a future slide, on an option, you may buy the stock at the strike price. You get to choose the strike price. Again, I'll show that on the next slide. American options, which are basically most options, expire on the third Friday of every month unless it's noted as either a weekly option or if there's a holiday on Friday. If there's also a holiday on Thursday as well, both Thursday and Friday, then it'll actually expire on Wednesday. So it always gets pushed back, never forward. So with options, it's pretty cool because you get to choose which strike price you want. You get to buy any of them that you want. Of course, the ones that are better do end up costing more. So for example, here I have a 14-day out strike price. That's what that little 14 there is. And we can see the current price of Tesla is what we're looking at right now. And you look at the bid price for the current price, that's 787. That's the current price of Tesla. However, if you actually want to buy Tesla, you have to choose a strike price first. So let's say you chose 765, and if you want to enter this, use the ask price if you're buying. So if you're buying, use the ask price. You just follow this number over, and then you'll see that it is $60.35. Does that mean it only costs $60.35 for one option contract? That's actually not quite right. It's actually times that by 100. So there are other symbols that are much cheaper than Tesla. Tesla is one of the more expensive ones. But that's basically 60 times 100, or in other words, $6,000 that this would actually cost if you wanted to buy that exact strike price with that exact option. I'll go over which one's the best on the last slide, but it's also important to note for the bid column. So this is the bid column here. And this shows basically if you want to short sell the stock, or if you want to get out of that stock early. If I already had this one, for example, then I could sell it immediately for this amount of money here, 59.40. So the difference between those is called the spread. You probably already know what that is if you've already been trading stocks. The different types of options, there's actually 4, not just 2 like normal stock trading. So there's either buying or selling in normal stock trading. However, here you can buy or sell calls or puts. So therefore, 2 times 2 is of course 4. So the ones in green here are the 2 ones that you want the price to go up. So either buying calls or selling puts. That means you are bullish on the stock and you want the price to go up. If you are selling calls or buying puts, you want the price to go down, and that means you're bearish. If you're buying calls, that basically means you have unlimited gains because potentially the price could go up, theoretically, of course, infinite amount of money. However, if you're selling, you only, if you're shorting a call, then you only get paid immediately what that bid price was. And then you only get paid it depending on if it expires in the money or out of the money. If you're selling, you want them to expire OTM, stands for out of the money. And for the puts, it's the exact opposite. So if you're buying puts, you have theoretically infinite gains, but of course it's not infinite because the price can't go negative necessarily. So it's not actually unlimited for puts at all, but it's almost unlimited. For selling, it's bullish, paid if strikes expire out of the money. So this one again, that's what a lot of people do is if the price actually ends up going up, then they'll be able to get whatever they were selling it for. That will be found on the other side, which I'll explain on the slide after this one on the screen right now. This is what it looks like if you pull up a new, if you pull up this for the first time, you type in TSLA. That's Tesla's ticker symbol. Those are called ticker symbols, usually 4 letters that make up a company. So you get to choose how far out you want to get your options, how far out they actually expire. You can't have infinite expiring options. You have to choose a certain amount of time for them to eventually expire. So sometimes zero is usually just a glitch that you don't usually see that, but unless you buy on Friday, I guess. But basically what you'll normally see is just these gray ones. And then sometimes they'll also have these weekly ones as well, like I was saying earlier. But the gray ones are the main ones as well. So basically what this means is you get to choose how far out it is until the price actually triggers, And if you are still holding and you're in the money, then you will be buying whatever 100 per option contract of whatever symbol it is. In this case, Tesla. So you buy 100 Tesla shares at whatever your strike price was for every option contract you have whenever it expires if you're in the money. So how much do option contracts actually cost? Now, this is something Greek letters does help out with, but I don't want to cover the Greek letters in too much detail because they're pretty useless, to be honest, especially if you are new, but it's kind of cool and it's kind of interesting to know them. They're not completely useless. I just don't use them so much. I know what they mean. I just don't actually want to use the literal letters in my when I speak, just because it will confuse a lot of people. So basically, it depends mainly on the volatility of the stock. Generally, if a stock is priced more, this is the raw dollar volatility. It's not just the percentage volatility. So, for example, Amazon, even though it doesn't move very much percentage-wise in comparison to Tesla, they usually because Amazon is more valuable per share than Tesla, but they move about the same dollar amount, so they cost about the same. Now it will vary a little bit more if depending on if Tesla's moving really fast or if Amazon starts moving fast, it will change. And then it also depends on how likely stock is to finish in the money. This is called delta. The delta is basically the percentage chance that it has to finish in the money. If there's more time until the option expires, it's called theta. It usually has more opportunities to move up or down, and therefore are usually more expensive the farther out the expiration date is. There are exceptions to this. Sometimes you'll see that the closer ones are actually worth more if they're really, really in the money. But the ones the ones that are at the money this falls really, really well. If uncertainty is high, the option may be expensive. If uncertainty is low, the option may be cheap. So that basically means if you don't really know what's happening with it, such as GameStop or AMC, these other ones that are moving very, very fast, they're going to be really, really expensive and a high spread, like we talked about earlier, the difference between the bid and the ask price, because the uncertainty is really high with those stocks. Whereas a stock like Apple is very, very much less uncertain. It's still somewhat uncertain, but not as much. It's much more safe historically. So therefore, the option spreads are usually much thinner on that one, along with a higher market cap in general. So it's also going to lead to smaller spreads as well. The last thing is gamma, which is the rate of change of delta. Don't worry about that one. It's just the rate of change of the percentage. It's not really that helpful for actual normal trading unless you get into some pretty advanced option strategies. So what I did here is I used the strike prices of 14. What this means is when on any of these that you click on, it'll show 14 of them equally spread of in the money options and out of the money options. So again, if you forgot, this purple or blue, dark bluish area here, those are the in the money ones. So over here we have more in the money, and this is the puts side, and this is the call side. That's why they're opposite. And then these ones are opposite as well. So these are the out of the money ones, OTM, and then ITM for both of them. And basically what this means is if you want, you can choose to either buy calls or puts, but I generally like to stick to buying only. I don't short that much. So I really only pay attention to the ask columns in both of them. You can pay attention to the bid ones, but I usually only pay attention to them when I'm actually exiting the options themselves and not so much when I actually am entering. So it's important to know that distinction. And this is really important as well. If you want to know how far you need to go into the money, I'll have another slide for this later. But basically what you can do is you can use the strike price, for example, 755 here. And if we're buying, so calls and the ask price is buying, basically, it's the one that I stick to the most. You look at that price, and that's basically how much higher the price of Tesla has to go from the strike price to add them together. And whatever that number is, that's how far up the price has to go for you to be actually break even on your option trade. So it has to go up at least that high within this amount of days, 21 in this particular case. So actually, really quickly before I move on to the next slide, look at the at the money options for the ask column on the calls. You look here, it's 57 and 55. This is for 21 days out. Let's see what happens if we change it to only 7 days out. So now it's really soon. You'll notice it's way, way cheaper now, only $34 or $33 because there's so much less time. That's why they're so much cheaper. So the price this will basically go down at an at a quicker and quicker rate. exponentially faster rate. It'll go down, down, down faster and faster until it gets to 0. Here's one more example. This is one that's really, really far out. So it's 357 days, almost a full year. And you can look at them as $246 and $242 for the at the money option. So this now is way, way more expensive. Keep in mind, that's not actually only $200. That means the price would have to go up or down by that full amount for you to be from the strike prices here, from these two strike prices, for you to actually be able to make money and be profitable if you held till it expires. Where is the best place to actually place your option contracts? Well, the best example I can give you is if you're already ready this very instant to enter an option, and you want to enter right away. So then what do you do? Well, you should get the at the money ones most of the time. So I usually like to get them about 50 days out or so generally, which some people think is really, really far. I like that amount of time just because it lets me, it lets the price develop more. And it's usually not too much more expensive than if you only got it 1 month out or so. So for example, here, if it's $86.30, look at this bottom one here. So from the strike price of 790, so I put that strike price in here. It's kind of hard to see it, underline it there, 790. That's where the green and the red line meet right here. So from that point, it has to go up by at least $86.30 to be break even. So that's this point here. So you can visualize that on the stock now by using these tools on TradingView. And once you know it's up there, then you can visualize, do I think within the next 49 days, will Tesla at least go up to that point or higher? Keep in mind, it should go higher, hopefully, because then it'll be in the money and actually be able to make money. So theoretically, for this theoretical trade, I think the price will come all the way up to here. So how much money would I actually make if I bought that particular option contract and we got it until it comes up to this exact price here, $916.81. Well, that's just about $40.85 in the money. What that means is per option contract, you multiply that number by 100. So 40 times 100 is 4,000. What this means is per option contract, you'd profit $4,000. Not just make that much in total. In total, you add them together to know the total value. But if you want to know your profit, you have to just look at the 40. And that's only if you actually let it expire. But again, I usually exit early, so you'll actually make a little bit more than 40, because it should be worth a little bit more than that due to the selling. And if it still has some time left, you can add that time left as well to be able to worth even more. But it's pretty hard to calculate that without getting into some pretty advanced mathematics. Let's move on to this other example up here. Now we're looking at this $88.60 one, but starting at a lower strike price. Lower strike price when you're buying is better. That means you get to get in at a $5 better price. So if you notice where this green and red line meet is better on the top one for buyers than the lower one. See, this lower one is a little higher. So we want to get our entry in as low as possible, of course, but keep in mind, you get to choose where your entry is. So again, this one does cost a little bit more. It's going to be $2 more. Again, the time to 100, so it's really $200 more for this one. And then we use this price now, $88.60. That gets us up to here. So anything above that is profit for us. If we think it'll come up to the same price level, the same for both of these, exact same price level. Well, how much money would you actually make? We'd actually make $43, again, times by 100, meaning you'd really make $4,353 as well. So just a really quick, most important abbreviations are ITM stands for in the money, OTM stands for out of the money, and ATM stands for at the money. So hopefully this is really helpful to you, and hopefully you feel more confident and ready to actually place your options trades. If you have any extra questions, don't forget to add them to the Discord or add them in the comments on this video itself. So thanks so much for watching, and I'll see you in the next one.